Welcome everyone. Another great company that our viewers have requested. I'm loving these reviews. In fact, they're becoming more popular than the FANG companies that we analyzed. So the Facebook, Apple, Amazon companies that we analyzed. So thank you, TechN, for the recommendation. We're looking at SupplyMe. Very, very interesting company. Now, essentially, they are a platform that connects funders with companies that have inventory. So think of companies that when they have inventory of stock, they spent a lot of money to acquire and buy that inventory of stock. They're going to need time to find customers to sell that stock to. And during that process where they're finding time, they're burning money to keep the company alive. So sometimes they need money in order to just keep them alive while they find buyers to buy the stock. Now, SupplyMe connect funders with those types of companies. And what they do is they will look at the value of that stock and they will say, okay, based upon that value, we will lend you this much money. And once the companies sell that inventory, sell that stock, they will use part of those proceeds to then pay those funders back. And SupplyMe are essentially like a platform. So Ted describes it as almost like confused.com, right? They're a platform where you can find those types of funders and get the best deal, right? And they don't sell it. They're just essentially just a broker for these types of businesses. So Ted, we actually found some interesting information about this business. I think it's the first time we've looked at a company like this. So this is going to be a really interesting one for our viewers. Ted, did I describe the company well? I've come across them before, but you're in the finance game, so you probably have seen this more than I have.
You absolutely did, Moeed. So you're absolutely right. This is what's known as working capital requirement. And traditionally, companies that they're buying stock, then they've got to sell it, or they've got to make it, then they've got to sell it, and then they've got to get the money in from their customers. Meanwhile, they've got to pay their suppliers. And you kind of describe it as this kind of, it gives them oxygen. It allows them room to breathe. So you may have heard of invoice discounting, where companies can sell effectively their invoices and get paid early rather than waiting for the full 30 or 40 days that they've negotiated. And this is just bringing that cash flow even further forward, allowing them effectively to fund the purchase of their inventory. Inventory must be held at the lower of cost and net realizable value, which basically means the sale price. If you're providing this finance, you can be reasonably confident that you've got the security there of the inventory sitting behind your loan. Okay, depending on how it's structured. So you need to make sure that the deal is actually secured on the stock if you are one of these financiers. So absolutely right. So let's go and have a look at the accounts. Now, this is quite an interesting set of accounts, because if you click on their, if you go to their website and you click on the annual report and accounts, what you'll find is Abal Group PLC, which was formerly known as Imaginatic PLC. So this company has been through quite a bit of a change over the last while. So here's the chairman's statement. So very briefly, at the beginning of the year, the group was providing a combination of software and consultancy solutions. So it was a kind of software consultancy organization. It really disappointing trends in revenues. It just wasn't working out for them. So they then had the departure of the chairman and the chief executive officer. They got a new CEO. They'd started discussions with the major investors. Those were terminated. They tried to kind of do some cost saving, etc., etc., etc. They did a fundraising in October, November. And then if you go all the way down to the, so then Angus left the company. So pretty, very, very turbulent time for them, 2019. And then what we see down the bottom is September the 2019, 27th of September, they buy SupplyMe SRL, which is an Italian company that has developed an innovative proprietary digital system which underpins a fintech platform that enables to carry out inventory monetization, which is basically exactly as you described it. So these guys have said, hold on a sec, this is a great platform. This is the future. This is where we are going to bet. Okay, so if we now go on to look at Abal, set of accounts, for example, we're really not going to see anything of interest at all. So because the company basically doesn't do what it was doing when these accounts were prepared. So if we actually look at the income statement, for example, and we'll just go down to the income statement so we can see it, we will see that the company effectively, the revenue is zero, the cost of sales is zero, the gross profit is zero, there's some administrative expenses, it's making a loss, but effectively this is all just irrelevant. So what we're going to do is we're going to look at SupplyMe, but we're going to look at this half-year report. So these are the interim report for the 6 months to the 30th of June 2020 from SupplyMe Capital PLC. So if we go down to the income statement, here it is. So this company revenue is 368,000 pounds. There's no cost of sales because it's just a platform. It's not selling anything. It's just matching buyers and sellers. Admin expenses, just over £1 million. Exceptional costs is effectively the cost associated with kind of listing, etc., etc. So that's a one-off. It didn't happen last year. You won't see it next year. So loss for the year is £2 million, but underlying loss is really about 800,000. So we need to strip this number out of that number if we think about it on an ongoing basis effectively. We can have a look at that exceptional loss. We'll just nip down to note 5 just so that we can see exactly what it is. So here we go. It's the cost of listing. So they've listed the company and it's 1.4 million. So it's an expensive it's an expensive job listing a company. Let's go to the balance sheet now and look at how strong they are. So really not a lot happening on the balance sheet. They've got the intangible assets, so that's the cost of the actual platform. They're owed some money by their customers, trade and other receivables. They've got just under £1 million worth of cash. And in terms of their current liabilities, the current liabilities are almost exactly the same as their current assets. So they are kind of, they're there or thereabout in terms of their working capital, and the share capital we can see here. They've been making lots of losses, and they've funded those losses by raising money through issuing shares. So we'll look at the cash flow because that'll kind of, that'll re-emphasize this. So the net cash flow from operating activities is about 900,000, which is similar to the underlying loss. If you remember, their loss net of the listing cost, we add back the listing cost because it's a one-off, it's not part of their operations. So they're basically burning about 900,000 in cash. And that'll be really the cost of running the business, developing the platform, the salespeople going out, finding the clients and selling, etc., etc. Not a lot of investing. Purchase of intangibles will be kind of software updates and developer costs, which are being capitalized, which is okay as long as it works and it's not too excessive. And you see down here in terms of financing, they raised 2 million by additional share issues. So the finances, really very difficult to kind of get a handle on this company as to, what do we think of it? It's, that there's clearly people who are out there, the 368. They don't have a lot of money sitting in the bank. So if you remember the money in the bank on the cash front, they've got 900,000 in the bank. They're burning at 900,000 a year. That kind of gives them about a year of run time before effectively they run out of cash. Maybe they'll go back and do another round of equity investment, fundraising. Have they proved the model? Be very interesting to see how they got on in the last 6 months of 2020. So really interesting to see an update on this figure here, whether it's starting to take off and whether companies are really finding that this is a good opportunity. Now, just to remind our viewers on Moeed that this isn't necessarily a company that is struggling, for example. So if you grow a company then the cash flow required around the working capital is one of the key constraints. And the way to think about that is, imagine if you set up a little corner stall, you're going to need some stock on the shelves, some money in the till, and then you can open it up. And if it's a little corner stall, you're only going to need a few stock. You're only going to need a bit of cash in the tills. But if you open up a massive out-of-town shopping center, you're going to need a lot more stock on the shelves and a lot more money in the tills. So an organization like that will allow companies which have got a really good idea, which are constrained by working capital requirements. They don't want to issue more shares because they don't want the dilution. They don't feel comfortable taking on long-term debt, which isn't really suitable for this, because debt is good for investing in plant and machinery and long-term investment. They want cash flow funding. That's effectively what they want. They want working capital funding. This, I think, is a really interesting variation on the invoice discounting concept of effectively bringing it a month forward and securing it on the inventory. So really, really interesting business model for these guys. Let's have a look at their share price. So share price, it's this is maximum. It's been 2020. It's been bouncing around a little bit. It's pretty low. You'll see the market cap is 117 million pounds. The shareholders' funds are about £1 million. So it's all goodwill in this company. It's all speculation. There's no price to earnings ratio because they're not earning anything. This is speculation, and maybe this company it's first to market. Maybe it's a unique. Maybe nobody else is doing anything like it. It's going to get out there. It's going to put its elbows out, and it's going to become the de facto. This is where you go in order to fund your business. I'm not sure about the barriers to entry. Fintech, it's been pretty easy for other people to enter into this space, especially existing invoice discounting companies who then just tweak their business models. They've got the clients already on their books. So it's a high risk play from an investor's point of view, but I think it's a really interesting business model from the company's point of view.
Yeah, I agree. And just to remind our viewers, right, look, when you're looking at a company, there are several dimensions to look at. We're coming at this from just the financial point of view, right? So which is absolutely important, but you're going to look at other factors such as who are the directors, who are the officers in the business, what are the caliber like, what is their